Howdy, Jacob here. Today we're going to be looking at the next company in our dividend yield screener, ticker symbol DAC. All right, so first thing I see, pretty much even enterprise value and market cap, so net debt roughly flat. Looks like they've jumped wildly in revenue in the recent 2 years on a trend downward for the previous 7 years. Even still looks like they've been pretty fluctuating with making money. Um, and they've only been paying a dividend the last 2 years. Not what you want to see when you're trying to have a lot of excess cash flow through dividends. But let's look at balance sheet. We said net debt about flat. Okay, yeah, that's pretty good. All right. Pretty good. See what they're doing with their free cash flow. So, almost this is weird. So, no capital expenditures until 2020, when now all of a sudden they went from nothing to 21 million to 171 million. That seems very interesting. But I mean, still positive. Um, the $60 million they're paying out. I mean, almost I think every single year. What is this? Yeah, every single year they could have afforded that. 72. Yeah. Okay. So, I mean, maybe I think it sticks. I think there's been a drastic change in the last couple years between 2019 and 2020. There's a big change. Um, what did I say this is? A marine transportation company. I wonder why it differed so much from due to COVID. Interesting. Um, but yeah, they've been buying back good amount of debt, huge amount of debt. With all their excess free cash flow, they just bought back debt, paid a little dividend, bought back a little shares. Okay, all right. Let's get making some assumptions here. So, I mean, that's 60. It's tough. The 60 million dividend they can afford, but they haven't historically paid dividends, so I don't feel comfortable in exceeding the $3.20 dividend that they have currently. So I think I'm going to assume that that stays flat. As for revenue, um, I mean, there's little acquisitions here, so this is all just like growth, and I don't know. That seems way too much recently, especially after it looked like it was declining. I might even say it's going to decline because let's see what we got here. So down to 850 million. Even that seems like kind of 680 million. That seems like a lot. So I don't know. Maybe just because I want to look into it sooner, I might just do -2%. Because again, no acquisitions, so there's just been wild growth, and I feel like that's going to taper down, especially with their previous years going down in revenue fairly consistently. So with that -2%, and if it's not growing business, I'm going to need a huge conservatism on the PE. 15 desired return. I mean, balance sheet looks great. Don't see any concern there. These assumptions are gonna be pretty wild. Let's do 20 and 30 maybe. And I don't know. They've been buying back shares recently because they've just been making so much money. But okay, so 37% drop to get to a 15% yield. I mean, if you're looking for excess cash flow, I think this $60 million they're paying out is very cheap in comparison to their free cash flow. The only thing is you're really going to have to look at what changed between 2019 and 2020 to where their model really changed, and They went from being extremely consistent business, which again, it's great to be consistent, but then you change so drastically to where your capital expenditures go from 20 million to seven times that, eight times that, upwards of over eight times that to 170 million, and then it's been keeping on way over what it has pre 2020. So you definitely want to do some more research on that before you get into this company. But I mean, a 4.55% yield looks pretty good, and um, you're just gonna have to make sure that these earnings and cash flow are going to be. Uh, I mean, I like that the cash flow has been way more consistent than the earnings. That's great. So really, just gonna have to make sure whether the cash from operations can stay similar to how it was pre-COVID, since it was just looks like there was such a big change. Thank you, and have a good rest of your day.